Welcome to my channel. I'm going to show you step by step how to value a stock. We will enter the company's financial information and capital structure into my Excel model. Then we determine whether the stock is a buy or a sell. At the end, we calculate and analyze the financial ratios. I am doing this with you throughout the entire video, so it's like we're doing it together. The company we're going to look at is NTN Buzz Time. This company broadcasts trivia and other games to over 3,800 bars and restaurants in the US, Canada, and the Caribbean. Let's get started with the model. They have a market cap of $12.5 million, so they're a really small company, micro cap. Let's see what they're trading at. $4.25. That's one share, $4.25, so it's a penny stock. And the stock went up 130% today. That's why I'm doing this video. It went up $2.40. I just entered the actual free cash flows for the business. And now I need the net income, which is on the income statement. That's the profit and loss for the business. And the net income includes non-cash items, where the free cash flow strips out the non-cash items. And then we need the revenue for each year. This is the sales for the business. Let's look at the numbers. So they had negative free cash flow and negative net income pretty much every year. Although in 2019 they did have positive free cash flow, so that is a good sign. Let's look at a capital structure. They have no debt. Let's get the cost of equity, so we need the beta. That's how volatile the stock is relative to the market. And usually penny stocks have high betas, but this has a beta of 0.5, so the stock doesn't move much relative to the market. Let's get their current assets, because we need to calculate the current ratio later. And current assets is the assets the company uses to run its day-to-day operations. And it's assets that the company can easily liquidate into cash. And that's 6.1 million. Let's get their current liabilities, and that's 6.1 million. That's how much money the company owes over the next 12 months. And let's get their equity. Equity is total assets minus total liabilities, and that's 5.1 million. Let's get their operating income on their income statement. That's negative 1.2 million. Let's look at a capital structure. They have no debt, 100% equity. The cost of equity is 6.2%, and that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company at $140 million. We divide that by 3 million shares, and we get an intrinsic stock price of $48. They're trading at 4.25, so they're trading at 91% discount. It's a buy according to the model. Simply Wall Street does not have a value because their value is based off of what other analysts say. And I don't think any analysts cover the stock. It's too small. I used a really conservative model to get a value for this company because their financials are really difficult to value with so many negatives. So what I did was I estimated the future free cash flows based off of the growth from their actual free cash flows from 2016 to 2019. Let's see where the stock has been trading at. So it looks like it's been coming down every year, and it was at a fairly low point until it jumped up today. Let's look at the financial ratios to see if we get more information. Negative PE, a really good price sales, and a good price to book. So PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. And they have negative net income, so they have negative PE. Price to sales is stock price over sales per share. To get sales per share, that's revenue over shares outstanding. And I like to see below 2.5, they're at 0.6. So investors are willing to pay 60 cents for $1 of sales. A price to sales below 1 is considered a great ratio. Price to book is stock price over book value per share. To get book value per share, that's equity over shares outstanding. I like to see it below 3.5, they're at 2.5, so investors are paying $2.50 for $1 book value. The current ratio is okay, negative ROE, Current ratio is current assets over current liabilities, so they can just cover their current liabilities. ROE is net income over equity, but they have negative net income, so they have a negative ROE. The only other company I did a video on in the same industry is Cumulus. And next to NTN Buzz Time, Cumulus wins in pretty much every category except debt. Cumulus has 69% debt, and Buzz Time has 0% debt. It's really interesting to look at a small company like this, because most of the times when I do these types of videos, it's on much bigger companies like billion-dollar companies or trillion-dollar companies. So to forecast a small company, you do have to make a lot of guesses and assumptions. You always have to make guesses and assumptions because nobody can predict the future, but it's much, much harder with companies like this. Let me know what you think of the video. Leave a comment. I always answer comments. Thanks for watching.